There are $10 trillion invested in zero-yield bonds and in negative-yielding bonds. For years, sovereign wealth funds, pension funds, and large money groups have looked to find shelter in these sure-to-lose assets. Why are they doing this? Ever since the Great Recession of 2008, investors have disregarded commodities and focused on deflationary assets. They're frightened that a massive panic is coming, so losing a tiny sum is better than the alternative. Dr. MARC FABER has given us one of his best interviews to date. I mean, he is as politically incorrect as they come, and it's refreshing to see such a change from people who walk on their tiptoes to please everyone and say nothing of substance. Enjoy this very entertaining and provocative one.
Welcome to the Titans of Industry show, and I'm very pleased to have a returning guest on, MARC FABER. And for anyone who doesn't know Mark, I mean, you must have been living under a rock or something. Very reputable investor for many decades, has called major bottoms. Gloom, Doom, and Boom Report is his very known and reputable newsletter, and I am very excited to have him on. So, Mark, thanks so much for joining us.
Yeah, my pleasure.
Definitely. And I want to start off with asking you a very important question for any investor today. And that would be, look, there's $10 trillion right now sitting in negative yielding bonds in real terms. Are there no opportunities outside of the stock market for investors to find real fixed income yield?
No, there are plenty of opportunities. First of all, there are REITs, real estate investment trusts. I invest quite a lot of money in REITs in Singapore, Hong Kong. They have dividend yields of around 5-6%. And they offer an alternative to, say, equities. And then we have utilities. Utilities are equities, but they don't necessarily move with the stock market. They're more dependent on interest rate movements. So recently the utilities index in the US made a new high because of the sharp decline in interest rates. The bond market rallied very strongly. So it's not 100% correlated asset class with equities, but it has an equity character, that I admit. And then you can buy real estate, you can buy an office building somewhere, and you have a return on that investment. You can buy a rental property that you let out, and you have also some income from that. So there are opportunities.
Why do you believe then that so many investment managers go for treasuries or for German bonds or for anything that offers such a low return? Is there not enough opportunities for that sort of capital? Obviously, $10 trillion is an enormous sum, so
it's about 20% of the government bond market.
So it's just the size of the capital chasing opportunities that's not enough for these money managers on the sovereign wealth level, etc.
Yes, that's the point. A lot of money is index money, and that is indexed in the case of the stock market to the MSCI World Index or to the S&P 500 or to any country stock market index. In the case of bonds, it can be indexed to a global bond index, sovereign bond index. And then these funds, whether they like it or not, they have to invest in some negative yielding securities. Or if you're a German or a Swiss or any European insurance company, by law, you may have to have a certain amount of your money that flows into the insurance company. You may have to have that in government bonds, in a diversified portfolio of government bonds. So they have to invest in negative yielding securities. But I want to advance a thought here that has crossed my mind and that I think is something to consider. On the surface, you and I would say it's crazy that a 10 years bond can have a negative yield. In other words, you're sure to lose money, but you're not losing a lot of money, but you're sure to lose money over 10 years' time. Now, why would I buy a bond where I'm sure to lose, say, 3-4% over 10 years and not equities?
I assume it's the same reason why you want to be cashed up in advance of major market corrections or crashes, etc., where the alternative that you fear is that if your money was in the S&P 500 or otherwise the Nasdaq or something else, the loss would be even greater. So you're banking on a small loss, and the risk you're taking is lessened than exposing yourself to what worked for the past 10 years, which is equities or U.S. equities, etc., where the downside might be even greater. Would be.
Yes, correct. I would buy this bond in the expectation that whatever else I buy would lose more money. In other words, I would take a very asset deflationary view, where asset prices, where I would expect asset prices, stocks, bonds, real estate to collapse by 30-50%. Then I would say, by owning a bond where I only lose 3%, I'm doing relatively well. But you understand, the thought would have to be expanded in the sense that can these sovereign bonds actually pay if all asset prices drop by 30-50%? Then I suggest that they may be bankrupt as well, you understand? So who knows? But it's a thought that an investor can make and say, okay, I have $1 billion. I want to have $100 million in something that where I won't lose. These are these sovereign bonds of high quality countries like Switzerland, Germany. I wouldn't call Japan a high quality country, but it's perceived as such.
Definitely. And let's continue with that thought, because in the past 10 years, the money going into deflationary assets has far exceeded money that went into inflationary assets, with the thought in mind of what you just said. I want to ask you, are we reaching a point where there's a big risk that investors are convinced that nothing will create major inflation, perceived or not? President Trump is talking about, hey, essentially there is no inflation. The government numbers that they publish, using their new ways of looking at things, and obviously what the Fed is releasing itself, it's all, hey, we can't meet that 2% inflation. We're just shy of it, etc., etc. And it just seems like investors are convinced that even with low unemployment rates, there is no money velocity and there is no trouble with inflation. Where on the flip side, about 72 countries now have gold trading at all-time highs in their national currencies. It's not happening in the US dollars, but for a third of the world countries, their currency is trading at all-time lows to gold. Is there a discrepancy here to how we measure inflation, to what is going on with inflation? Because some people in the most important part of their lives, the most important aspects of their lives, like tuition or insurance, they see a huge inflation in prices, and they can't reach the education path that they want in life, especially in the U.S. And then on the flip side, you see situations where there's low inflation in stuff that doesn't matter, or that doesn't it's not meaningful to change in terms of dollar volume and price. So where do you see this entire question of inflation and how we measure it, and this risk that everyone is now targeting inflation to be higher?
Well, first of all, I mean, I don't want to give here an economic lesson or a monetary lesson, but for me, inflation is an increase in the quantity of money, and as a result of the expansion of the balance sheet of central banks all over the world, there has been a very significant increase in the quantity of money. Now, this money, and this is the weak point of central banking, this money flows at the present time the way the central banks have accumulated these assets, and there are other ways the central banks could distribute money, but basically that money went into the financial system, and from there it went into asset prices. In other words, let's say I have a huge bond portfolio. I'm an insurance company in Europe, and the ECB buys my bonds. Then I have money, and with that money I can buy stocks, I can buy real estate, and I can buy an art collection for my building or for the offices of the CEO, as is often done, and so forth and so on. So you understand, to say that there hasn't been inflation is, of course, complete nonsense. We also have statistics that show that the millennials, in other words, the people born after like 1983, 84, until the mid-1990s, at 35, they have less money than their parents had. In other words, my generation, the baby boomers, and they earn in real terms less than their parents did. Partly because the cost of living has gone ballistic, particularly rents and medical cost, and as you pointed out, educational cost, and lots of small things have become very expensive. I mean, I'm now, it's difficult to say, I'm 73, but I can tell you, when I compare the prices when I grew up to the prices of today, I have to say, there has been actually a colossal amount of inflation. And the colossal, and I have to point this out, the colossal depreciation in the purchasing power of money, of cash. Now, you could have protected you from this depreciation by owning equities. Say the Dow Jones, when I grew up, touched 1,000, you know, where we are nowadays. And the Hang Seng Index, when I moved to Hong Kong, it fell from 1,700 to 150, in other words, down more than 90%. And now we're at over 30,000. So you could protect yourself from this asset inflation, from this monetary inflation by owning assets. Even gold, when I went to school, gold was $35 an ounce. So cash has lost purchasing power. There has been inflation. But on the other hand, and that is true, a lot of good prices, you know, like a mobile phone, a calculator, a handheld, a simple computer. My computer always costs more because I need a little bit more sophisticated computers. But all these things have kind of come down in price. But the cost of living for everybody, wherever he lives, has gone up a lot.
What you're saying is exactly what I've been thinking for many, many years, and it's so true and detrimental. The inflation has went into assets which the rich own, or the rich can afford to participate in, like the S&P 500, the Dow, the Nasdaq, etc. Home prices, bonds, everything that the upper classes purchase has gone up in price and has been treated very well by the system. And anything that doesn't yield any cash flow, like a mobile phone or anything else that is actually just simply an expense, it might have gone down in price, but it doesn't help anyone when you buy it to make a return. It seems like there's two economies since 2008. There's one economy that favors the people that benefit from the system, benefit from central bank inflation, from generating of new currency units, and those are the people that have had money going into the crisis, and therefore their recovery happens sooner and in a much more expedient manner. And for the average person who's seen a 2 to 3% rise in real wages, but only in the past 2 or 3 years, and has seen more competition for every job that there is, his situation has grown worse, and Ray Dalio talks about that a lot, where one person out of 1,000 people that you randomly choose in the U.S., he owns more wealth than the bottom 900 combined, and he's talking about the social ramifications of this. And I want to ask you, because you reside in one of the wealthiest areas in the world, which I visited not too long ago in November. I've been there. It's an amazing place. Hong Kong, Singapore, that entire area is beautiful and very advanced, and it's wealthy. But I want to ask you, when I travel here in the U.S., which I've done for the past 3 months, it just wherever I go, I fail to see that middle class lifestyle that I saw 20 years ago. It's either very wealthy or very comfortable, or the rest. And yes, it's not just the homeless, but you see signs of poverty, and more disturbing, you see signs of lack of opportunity. I don't see a way for these people to advance rapidly, even if they have good skills, because they're blocked from many job opportunities that require some sort of a degree that they can't finance, or if they finance it, it's at a cost of too much for their student for a student to take on. It just seems like there's an opportunity gap, even to accompany the wealth gap. But on the flip side, I don't see too many people, taking the approach of activism and really revolting like you see in Europe. You don't see that too much in the U.S. What do you think has happened in terms of the average person to make him? Do you think people are being indifferent in today's world compared to your generation, which we saw was taking a lot of action when the government was putting in front of them stuff that they didn't want to see?
Well, I mean, first of all, you ask actually a number of different questions. First, you talk about Asia, how rich Asia has become and so forth. And yes, places like Japan, South Korea, Taiwan, Hong Kong, Singapore, and to a large extent also Malaysia, they were dirt poor. And also the major cities in China, they were dirt poor in the 70s. And now many of these cities are wealthy, and they have an infrastructure which is far, and I repeat, far superior to anything the US has. Anything. You just have to look at the reports about the best and the worst airports in the world. And most of them, of the best ones, are actually in Asia. And so the question is, how has Asia progressed as much as it did in the last 30, 40 years, whereas the West, including especially the US, has to a large extent gone backwards for most people, as you pointed out. And here I have to say, the reason is that the Asians work. That is the reason. And I disagree with you I think in the US, a degree is meaningless. But someone who is reliable and works and not on opioids, an alcoholic, or another kind of a drug addict, can actually get a good job, provided he is willing to work and is reliable. But that has to be met. And the young people today, these millennials, the problem is that a lot of millennials are either spoiled brats in the sense that they don't want to work and that they are supporters of the socialists like Alexandria Ocasio-Cortez, or they are children of affluent people, and so there are a lot of jobs that they don't want to do. I mean, I know lots of Hong Kong billionaires, they started as coolies in 1945, 1950, and they worked themselves up. And a lot of wealth in Asia is actually from poor people working themselves up, the same way in the US and in Europe. But the attitude today to spend time at universities on political correctness and all this nonsense, that has a growth inhibiting factor. And that we don't have yet in Asia, luckily.
Now, I want to ask you one final question, because this has to do with how we address these issues. And one of the things that Larry Fink, who's the self-made billionaire, the founder of BlackRock, the biggest asset management company in the world, and what he's talking about, Mark, is he's saying, look, 40% of these entitlements, 40% of this deficit spending that the U.S. allows itself to do, 40% of these bonds are all being bought by foreigners, and no other country has 40% of its budget and its deficit financed by other countries. And he's saying, look, if they don't see the promise at the end of the road, if they're seeing new negotiations to trade deals, if they're seeing that everything that has worked as status quo for the past 30, 40 years is being renegotiated, reinvestigated, etc., why would they keep lending us money for us to fund our retirees, or to fund our military, or to fund our income security, etc., and even to fund our own income, our own interest payments to them? They are actually financing their own interest payments by lending new money to Washington. And he says, look, this is a big, in fact, he says this is the one problem that I think about most of all. So I want to ask you, you're in Asia, you see the attitude towards U.S. generated debt, toward treasuries. Is this the point where the rubber meets the road, and you're going to see a major change in how these countries are willing to lend America money for 10 years at 2.5%, which is insane, like you said?
Yes, but I just like to say, it's insane. But it's less insane to lend money for 10 years to the US at today's yield, 2.519%, than to Italy at 2.53%, to Spain at 1.13%, to Portugal, listen, to Portugal at 1.26%, and to Japan at a negative yield. You understand? It doesn't make any sense. There's a interest rate repression. In other words, we have artificial low interest rates. But if you put the gun on my head and you say, Mark, you have to lend money for 10 years to Italy or to the US, I think I would choose the US.
Understood. It's a game of...
Number two, I mentioned to you before, the index funds, the bond index funds, the paradoxical situation of bond indices is that the more debt you have, the higher weight you have in the index. And so if you are a sovereign fund and you say, I want to have a bond portfolio or some money in bonds, and you index it more or less, then by definition, you will have a large exposure to US bonds. I think in a few years, you will have probably a large exposure to Chinese bonds.
Very interesting, Mark. Mark, where can people check out more of your articles, your work, the newsletter, etc.? Can you tell people the best way to follow you, and if you are also on social media?
The website is gloomboomdoom.com, all in one word, gloomboomdoom.com.
Mark, thank you very much for taking the time.
Well, thank you very much for the interview. Bye-bye. Take care. Thank you.
Marc Faber is just the beginning. Coming up, Wealth Research Group is about to release an update on the dollar with John Rubino in a matter of days. On top of that, there's a big interview coming that deals with incredible alternatives for income and growth outside of the stock market. This is a must-see for all yield seekers, retirees, and investors looking to diversify out of the stock market income only. Lastly, check out Wealth Research Group's founder interviews with Carrie Lutz of Financial Survival Network, which was just posted.